The first place I want to look is going to be the jobs report for the month of February, which came out last week. 151,000 jobs were added to the economy. The unemployment rate for the month of February was 4.1%. Both of those numbers are going to be in line with expectations heading into the report. What exactly does a 4.1% unemployment rate mean? Well, within the report, we see that 7.1 million people are classified as unemployed. We're going to round numbers for this conversation, so let's just call it 7 million Americans are currently classified as unemployed. Two other data points I want to take a look at as we scroll through this report. The number of people not in the labor force who currently want a job. So the fact that they're not classified as within the labor force means they hadn't been seeking a job for the previous 4+ weeks. So they're not lumped into the unemployment number. However, these are folks that want to be working. Nearly 6 million Americans fall into this category, okay? Another data point we want to take a look at. The number of people employed part-time but would prefer to be full-time is an additional, call it 5 million people. So my question is, what is the total population of unemployed Americans at this point? Is it 7 million that gets us the 4.1% unemployment rate? Or do we want to add in 5 million on top of that are part-time that want to be full-time, plus an additional 6 million that don't technically fall into the unemployed category, but want to be working? Because if that's the case, that doesn't get us 7 million Americans. That gets us 16 million Americans. And with a total working population of, there's something like 160 to 165 million Americans who are working. Well, if technically there are 15 to 16 million who want additional employment, whether it's part-time to full-time or no employment to something, that's roughly 10% of our labor force who's not getting the type of labor that they want. So 4.1% is going to fall under more of a generational low, right? But if you actually take a look at what the labor force participation could be, if these people got the type of jobs that they wanted, is it crazy to think that an actual unemployment rate could be closer to, 9%, 10%? I think that's not crazy to think about, right? So here we have the labor force participation rate. I'll do my best to get everyone to take a look at this here. So this is going to be the total population that falls under the working age versus people that are actively working or seeking work. This is going to be the 1-year chart. I'm hoping everyone can take a look at this. So we do see that it is not only going to be lower than kind of your generational zoom out back to the 1960s, but it's actually descending as well. And we have not yet gotten back to pre-pandemic levels in terms of the population that's working. We haven't been this low since really going back all the way to the 1970s. And during the 1970s, it was much more common for both members of the family not to be working, right? It'd be more common for perhaps the woman to be at home, the wife to be at home. So we wouldn't necessarily expect that the workforce participation would be on par with where we'd be today. So a couple takeaways here. The labor force participation has been decreasing over the past 12 months. We have not yet gotten back to pre-pandemic levels, and we're actually right back to where we were in the 1970s when it was much more common for certain members of the family not to be working. What does that mean in terms of what people expect the economy to look like? So here we have the University of Michigan Consumer Sentiment. This is going to be phone calls placed to everyday Americans once a month asking, what are your feelings about the economy? How do you feel about your personal finances? How do you feel about the economy? How do you feel about the way things are headed? And over the past year, we see that people's opinion, so everyday people like you and me, their opinion of the economy has been decreasing. And it hasn't just been over the past 12 months, but we can see we're at lows going back to levels that would be indicative of recessions. So if we take a look at the gray areas here during certain troughs, the gray areas are all going to represent areas of recessions. So for the most part, not 100% positive or not 100% certain. There's not a 100% correlation, but there's a very strong correlation between where we are in terms of consumer sentiment about the economy and there actually being in a recession. So we know there are questions about employment. There are doubts within families in terms of how strong the economy is. What does that mean in terms of people's savings? Well, here we have a 12-month chart for personal savings. How much are families saving? And it's a pretty aggressive downward trajectory. So we went from a high of back in Q1 of 2024 of 1.1 trillion. And in just less than over a year, we've shaved off roughly, call it 25% of what people are saving. And if we zoom out a little bit, we'll go back to a 10-year perspective. This is interesting because if you think back to the level of the amount of savings we have today is going to be pretty close to where we were in 2016, 2017. Well, what do we know about those periods? We've had significant levels of inflation since then. So while the dollar amounts are going to be relatively close, the purchasing power that those savings can actually get you is going to be, call it 10 to 15% lower than it was back then. So maybe it looks like we're on par with kind of where we were 10-ish years ago, but in terms of what those savings dollars can actually get you is going to be significantly worse. So we have an employment picture that's a little bit cloudy. We have families that are unsure about the direction of the economy. Saving rates are falling. What does this mean in terms of delinquency rates? Well, first we'll take a look at mortgage delinquencies. So these are people's houses. These aren't businesses. These aren't large apartment complexes. These are 1 to 4 unit residential properties. And we can see the delinquency rates over the past 1+ years, they're growing, and they're growing pretty fast too. Now, the rates themselves from a historical standpoint are still going to be relatively low. So we're not at historical highs in terms of delinquency rates. What I want to focus on here is the trajectory that the rates are going. So just year over year, 10 basis points was the increase in terms of delinquencies. Right now, we're right around, this comes to us from the Mortgage Bankers Association. Roughly 4% of all residential mortgages are in some form of delinquency, and delinquency means 30+ days past due. Interesting to note here, they do break it out in terms of the type of loan. So we see blue is going to be the spread between, and we'll kind of walk through this together. It can be a little bit confusing, but the blue line represents the spread between delinquencies in FHA loans and conventional financing. The difference between those two products is FHA is going to be more catered towards first-time home buyers. Generally, they're going to have lower credit scores. They're going to have higher debt-to-income ratios. So what does that get you? And again, the blue line is comparing that to a conventional loan. We see the spread between them is almost a full 8 percentage points. That's a hefty margin. So when we say things like, oh, we want to encourage people to get their, to get their first houses, we want to get them, grant programs, we want to lower credit score requirements. There are downfalls to that, and the downfall to that is going to be increased number of delinquencies, people falling behind on payments. So we know that the mortgage picture is not in a dangerous area. I want to make sure we get that across. We're not in any type of housing crash. However, again, the trajectory is not going in a positive direction. It doesn't just stop with housing. So we're also going to take a look at auto delinquency rates. And sure enough, over the past year, it's aggressively increasing. And this is going to be, when we compare this to something like, if we zoom out 3 years, we'll take a look. It's pretty shocking the level of increase we've seen in consumers falling behind on their auto defaults or on their auto loans. There's a couple reasons for that. Interest rates over the past couple years on auto loans have gone up significantly, so it's becoming more and more difficult to make payments. And also we know that since the pandemic, the purchase price on vehicles has gotten significantly higher too. So higher interest rates on your auto loans, higher purchasing points, it's becoming more and more difficult for people to make their payments. How are they making payments then? So if we know that the employment picture is a little bit shaky, we know that savings rates are going down, how are people able to stay afloat? And the answer is overwhelmingly using debt. And by debt, we mean credit cards. So here we have total outstanding credit card balances. So this is the amount of debt that people carry over month to month, is just over $1 trillion. And if we think about the average credit card interest rate, what is it? It's probably somewhere in the 25% range. So if consumers have $1 trillion worth of credit card debt. Just in a 1-year period, the American consumer is going to pay somewhere, let's call it $250 billion of interest on credit card debt. So this is pretty alarming. And on top of that, not only are we racking up significant levels of debt, but we're also draining our retirement accounts too. So this comes to us a yearly report put out by Vanguard. Vanguard is one of the largest asset plan holders in the world. And they found that in 2024, hardship withdrawals, so people that are taking out of their retirement accounts early, increased to 4.8% over 3.6% the year earlier. And actually, from the research I've done, the long-term historical average is going to be closer to 2%. So we're racking up credit card debt. We're draining our retirement accounts at a more aggressive rate than we usually are. These are all alarming matters, and these are all things that we want to take a look at. So, over the next few weeks, we're going to see a lot of stuff about tariffs. We're going to see a lot of stuff about, government downsizing, treasury rates. There's a lot of noise going on. These are a few of the individual metrics in terms of families, everyday Americans, that I'm going to continue to monitor as we